This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Maddie, we've gone, almost this whole week without talking much about Bitcoin.
I mean, I can't believe you've been able to do it, Tim.
I know. Well, I've been saving it for this afternoon because it's our weekly segment where we talk about cryptocurrencies. Very pleased right now to have Muneeb Ali joining us. He's the co-founder and CEO of Trust Machines, also the co-founder of Stacks. Muneeb joins us via Zoom. Good to have you with us this afternoon, Muneeb. I'm on your website for Trust Machines, and what you promised to do is build a decentralized economy on Bitcoin. I think what people understand about Bitcoin and cryptocurrency is how we can use it as a currency, but I don't think a lot of people understand how you can build on it. What do you mean by that?
Yeah, absolutely. Thanks for having me. So I think if Bitcoin is money, so what we are talking about is building the entire financial infrastructure and financial markets around it. And we've actually seen early signs of that in other ecosystems like Ethereum and Solana, but Bitcoin happens to be the largest network, the most durable, the most recognizable brand. And I think it's sort of like surprising that so far we haven't seen more financial infrastructure built around Bitcoin itself. Like
what would you think that should be built on it right now?
I think the things that come to mind, first of all, are decentralized exchanges. Obviously, we know about Coinbase and we've seen the FTX blowout. So if things are decentralized, if people can just trade in a decentralized way, that's really good. Even bringing stable coins to Bitcoin. Most of the stable coins like Tether and USDC, right now they're issued on Ethereum and some other chains, and they're not really sort of like working on the Bitcoin rails. And I think bringing stable coins to Bitcoin, building lending protocols, again, we saw things like BlockFi blow up. So if there were decentralized lending protocols directly built on top of Bitcoin, I think people could have really benefited from that.
When you think about the trade of Bitcoin, it seems like it's losing its mojo a little bit, right? When we look at it year to date, we're not seeing as much of the volatility that you usually see when it comes to Bitcoin. It's gone 8 trading sessions as of today without a 1% move. What does that tell you? Are you concerned at all about Bitcoin as kind of an asset class?
So this is my third bear market, right? And I think this is probably the most pleasant bear market that I've been through. So I consider us to be in a bear market. I think given for a bear market, this is actually a pretty good trading market to be in. Things aren't looking that gloomy. And I think I would be just looking forward to the Bitcoin halving, which is scheduled for April next year. I think historically, again, this is how the market has been working. No guarantee it will work like that in the future. But historically, around the Bitcoin halving is when markets pick up. There's a lot more excitement, and because it's just the market dynamics. The supply of Bitcoin goes down even more, and I think people get more interested in it.
Well, what's interesting though, when it comes to what markets are more interested in, is that we have this really cool word search function on the terminal. If you want to nerd out with me for a second.
I do. I don't know what you're talking about.
And it looks
great.
Well, you can do DSGO to document search, but smarter people than me just write it up for me, so I don't even have to use the function, to be honest. But one of the reports from this week looks at how Barbie mentions outbeat Bitcoin for mentions on the terminal this week. So, and that's the second week in a row that's happened, by the way. So what does that tell you? Does Bitcoin have a PR problem? Do they need to become a Barbenheimer to get back into the zeitgeist here?
Yeah, so I think I'll go back to this 4-year cycle theory, right? So we see these spikes. Bitcoin basically does a 10x or so, right, in terms of number of users. In the first cycle, we went to like 1 million users, then 10, and depending on how you count, maybe the last one was getting closer to 100. So I think the interest goes down as well, but this is the time for builders, right? So this is something I've seen over and over, that companies and developers who really believe in the technology, they basically catch up on things during this bear market cycle, right? So a lot of great products get built. A lot of people were basically building for the next years. They get their work done, and then the next wave of interest comes. So I think we're definitely in a bear market.
What are you seeing built right now?
Yeah, so some of the things that I'm really excited about is Bitcoin L2s. If you look at Ethereum, It's something like a $250 billion market, and it has a $50 to $60 billion L2 markets. L2s are these layer twos that are built on top of Ethereum. They help it scale, they bring more users and applications to it. And for the first time, I'm seeing more of that happening on Bitcoin, which is absolutely critical. So you mentioned the Stacks project. I'm a co-creator of it. Stacks is a Bitcoin L2 that helps sort of like bring more applications or being able to just do like cheap and fast Bitcoin transfers. They will happen on the L2s and not on the L1. And I think these are still maturing more on the Bitcoin side, but some pretty exciting stuff happening.
Given that we're still in what you describe as a bear market, or what others describe as a crypto winter, are you seeing interest around the space just cool? I mean, Maddie brought this up about Barbie versus Bitcoin, but are you having trouble finding employees? A couple of years ago, what we were talking about was, hey, these are all people leaving Wall Street to go work at crypto firms.
Yes. So I think the one interesting dynamic of what happens during the bear market is Bitcoin dominance actually goes up. So some people who track the Bitcoin dominance, it's actually at the highest right now, which just means the market cap of Bitcoin versus all the other assets. So in some ways, it actually becomes easier to hire for Bitcoin companies because people get more burnt by all the other assets, right? That might be riskier, or there might be all sorts of nefarious people behind those projects, where Bitcoin is this neutral, truly decentralized grassroots movement, and people gravitate towards that a little bit more. This is within the crypto industry, but broadly speaking, yes, I think it's not the crazy times, but sometimes it's also a really good filter, because now you're not getting the mercenaries. You're actually getting more mission-driven people who actually believe in decentralization, who believe that building these systems is actually a good thing. So I've always enjoyed the bear markets. I think the signal-to-noise ratio actually improves a lot. There's a lot more signal in the market, and so drifters, they go away. I think they're going to AI these days, and
that's the way this is. That signal or noise in AI, though?
I think as a computer scientist, I'm definitely interested in a lot of the breakthroughs that have happened recently. I wasn't a believer like 5 years ago, but I've seen some really good stuff come out. But again, it's like the overhyping of something and people just jumping on the bandwagon stuff that we need to be a little bit careful of.
Hey, what's it going to take, Muneeb, to get crypto out of this winter?
I think I am a firm believer in Bitcoin first. I think the rest of the industry is sort of like attached to it. Bitcoin has a clear product market fit. I mean, we're seeing the turbulence in the financial markets. We're seeing inflation just go through the roof throughout the world. Like, I think it's not just in the United States. Like, I have my parents who live in Pakistan, and whenever I send dollars to them, a dollar is worth like 3x more just in the last 2 years than what it used to be. So people are feeling the pain, they're feeling inflation, and they're realizing what a hard asset means, what a gold-backed currency could have meant. And I think Bitcoin is sort of like the best thing out there. And what happens is whenever interest in Bitcoin goes up, then there's a long tail of everything else that sort of like picks up on it, right? So I feel like if you believe in Bitcoin, if you think the world needs a better money, and Bitcoin is the best money invented so far, and it's almost like an open source thing, right? It's a technology that's out of the box, very hard to stop. So I think when Bitcoin rises, everything else is going to rise with it.
All right. Well, we're going to have to leave it there on this Friday. Muneeb, thank you so much for joining us. Muneeb Ali, co-founder and chief executive officer of Trust Machines. I should mention you're also the co-founder of Stacks, coming on to talk crypto with us for our weekly crypto segment.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
That jobs report, we've been talking about it all day, Tim, because, it had a little something for everyone, right? You've got the job growth remaining steady, non-farm payrolls climbing slightly less than forecast, potentially a victory for the Fed there. But the bad news for them, wages still going up.
Hey, that's good news for us.
That's good.
As workers,
great
right?
News for us, Tim, and hopefully for our listeners here. So joining us to discuss and kind of suss out the top line takeaway here for us is Julia Pollak. She's the chief economist of ZipRecruiter. And Julia, it's great to have you on again here. I'm trying to figure out how to read the good and the bad news of this report. So just in terms of putting it into historical context for me, would you say this is the first report we've gotten that puts us back to pre-pandemic levels and vibes?
Yeah, this is pretty much in line with the pre-pandemic rate of job growth. But I would say on wage growth, I don't think this is all worrying news for the Fed and on the inflation front, because the work week has actually become shorter over the past year. Average weekly earnings have only risen 3.5%, even though average hourly earnings have risen 4.4%. So that 3.5% weekly wage growth is completely consistent with the Fed's 2% inflation. And then the data we got earlier this week on productivity also suggests that high wage growth is sustainable because productivity is rising.
Julia, we love talking to you because on ZipRecruiter, you have a great insight into the types of jobs people are looking for and the types of jobs people are applying for. Michael McKee, our international economics and policy correspondent, was in here a little earlier, and he was saying there's a little bit of debate about, okay, are people just not hiring at the same rate that they were hiring at earlier, or are people just not wanting to work at the same rate that they were wanting to work at earlier? What are you seeing on your platform?
Well, job seekers have come back, and we've seen job seeker engagement on jobs rising 69% over the year. So it's not that workers are not available and not ready to work, although many employers say that while they can find entry-level workers quite easily, they're struggling to find people with specific credentials and qualifications. And they're also struggling to find people, with 5 to 10 or 10 to 15 years of experience. So quality is still a tricky issue for
Why
employers.
is that?
It's hard to know. One issue is that many older workers left during the pandemic and they have not returned, and they've taken a huge amount of skill and knowledge with them. Many industries are also finding that the talent pipeline has sort of run dry. Fewer workers are majoring, say, in accounting. It's just not such an exciting, appealing career anymore for young people who would rather be in tech or in social media or vlogging or goodness knows what.
Influencers.
So, exactly, they'd rather be
economy left and
influencers.
right. Well,
they'd rather be celebrities.
Yeah, and it's so interesting. I want to pick up on that because we were talking with Mike McKee, as Tim said, about how the biggest job loss category in this print was in management. We're starting to see, at least in the data, that companies are kind of hoarding that lower skilled, cheaper, more affordable labor and getting rid of their higher level employees that cost them a little bit more. So help me understand where you're seeing that. You're seeing less people with more skills out there available to be employed?
Yeah, so it's a challenging situation for employers. We're also seeing employers move away from their sort of excessive reliance during the pandemic on contract workers and temporary help agency staff. And they're shifting from those temporary recruitment strategies like signing bonuses to more long-term workforce management policies. We're seeing a large increase in the share of job postings on ZipRecruiter that offer health insurance and that offer retirement plans. And that's a good sign to me. It suggests that employers are actually hiring in-house staff and trying to find ways not just to get them in the door, but to keep them there and keep them happy.
What about getting employees to the office? We've spoken to you several times over the past few years, Julia, about listings that show hybrid work or remote work. There's been a lot of discussion, at least here in New York City, about getting workers back to the office, and also from companies such as Amazon and more tech companies like Apple as well. What are you seeing on the platform?
So remote listings have mostly plateaued in most industries, although there are several industries where they have declined recently, like in customer service. There are some where they continue to rise, like in consulting and financial services. So it really is a mix. And companies are carefully weighing the trade-offs, the cost savings, the recruitment benefits, the retention benefits. Some studies show a decline in attrition of 35%, which dramatically lowers your turnover costs. So there are huge benefits from remote work, but one needs to do it right so that one doesn't lose mentorship and collaboration.
Well, we know that remote work is one of the things contributing to that attrition and people switching jobs. I'm curious about pay when it comes to switching jobs, because we know from the ADP report earlier this week that you do stand to gain on the wage front when you switch jobs. You're getting about a 10% increase in wages as opposed to 6% when you stay in the job that you currently have. What are you seeing on your platform when it comes to the ability for workers to get higher salaries if they are kind of job hopping around?
So the majority of job switchers are still getting pretty substantial wage increases, but the share who are increasing their wages when they switch is actually going down. Part of that is a matter of choice. So workers are prepared to give up pay in order to get remote work. They're prepared to give up about 8 to 10% of their pay because remote work saves you time and money.
That's a lot to give up for remote work.
Yeah, but think about what it... Well, go ahead, Julia.
Yeah, but if you gained 70 minutes a day that you would have spent commuting, and if you save $5,000 a year on transportation costs, it can really make up for it. And then if you have
70
children,
minutes a day?
yeah, and if you have children and you spend a lot of
Exactly.
time in the car and you have to pay for childcare, for that during that commute, and you sit there in the car feeling like, how on earth am I doing this, wasting my life when I could be with my kids and I'm paying for childcare on top of it? Those kinds of savings are not just financial savings, but they're psychic cost savings as well.
I feel like I'm getting triggered here by you saying those things, but it's true. I mean, I spend about 45 minutes round trip commuting from my apartment.
Wait, but Tim, say the thing you said earlier about productivity and the return to work.
This is interesting, Julia. We have a story out on the Bloomberg about a study that economists at MIT and UCLA did that shows that people are less productive at home by about 18%. Right. These are new hires, and they did an experiment, new hires in India. But they did talk to somebody for the article who said, you know what, these people might be less productive if they're at home, but the company may save money on real estate. So if the company's not spending the money on real estate, it's okay to have these lower productivity workers.
So the real estate savings are actually a small piece of the pie because in most companies. In most companies today in the United States, in knowledge industries, your biggest cost is your people. And when you can recruit people across the country from lower cost places, you can get talent much more cheaply. And then if they're prepared to do the job and stay there for longer without big wage increases because they're so happy and they enjoy the work-life balance that they've got, you can save and have reduced wage growth pressure as well. So there are lots of reasons to sort of balance the productivity and cost savings benefits. Then the evidence on productivity is mixed. There are plenty of studies that show productivity gains, like studies of customer support agents that found that they gained an additional day a week of productivity because they made many more calls during times when they would otherwise have been commuting.
Julia, 10 seconds here. What type of employee is having the easiest time finding work right now?
Healthcare. The industry is on a tear. It's gained enormous numbers of jobs for 18 straight months now.
Well, we got a great story on healthcare coming up a little later today with John Tozzi during the 5 o'clock hour. It's about the changing relationships that employers have with the health insurance that they're paying so much money to insure their workers. Julia Pollak, really appreciate you taking the time. Chief Economist at ZipRecruiter, joining us on the July Jobs Report and all things employment.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
There's a little something for everyone in the jobs data today, but we think so much, Tim, when we get the jobs data about how the Fed's going to respond, which can make the good news seem like bad news, right? More jobs and pay means the Fed raises rates, but of course, that's bad news for anyone looking to buy a home. But then we think, okay, less jobs, the Fed may cool off, but then there are fewer jobs. You got to remember that that's bad news for people too. So we wanted to focus today on the people impacted by these numbers and the data that we talk about so often. So right now we're specifically going to focus on the Hispanic population when it comes to that data. And we've got a great guest here to discuss, Javier Palomarez, the president and CEO of the U.S. Hispanic Business Council. And Javier, great to have you. Thank you so much for coming on with us. When you look at the data from today, we're seeing that for Black workers, the labor force participation rate did tick slightly higher. And the same was true for the unemployment rate when it comes to Hispanic workers as well. But I'm curious, what was your biggest takeaway from the data today?
Well, I mean, if you look at the numbers, let me begin by saying, first of all, that I want to thank you for having American small businesses' voice on this. The United States Hispanic Business Council is a leading advocate for our nation's 4.5 million Hispanic-owned firms in this country that collectively contribute over $800 billion to the American economy. We watch these numbers very carefully, as you can imagine. 187,000 jobs is not exceptional, but it's what was predicted as it relates specifically to the Hispanic market. When you look at where the majority of the growth happened, it was construction, healthcare, wholesale services, things of that nature. And when you look at Hispanic employment and where Hispanics are, there's a concentration of employees that are Hispanic descent. Those happen to be the sectors. So while the numbers specifically when you're looking at Hispanics may not be great, we're very enthused about what we've seen. The numbers for us overall are on track. And so, I think that, better days are ahead of us. But certainly the numbers today, they hit the projection.
What are you hearing from the businesses on the ground, from these millions of people who you represent at the United States Hispanic Business Council, the millions of businesses? What are they saying?
Well, the market is tight. It has been tight for some time.
When you say the market is tight, are you referring to the labor market?
Absolutely. It's really about first attracting the kind of worker you need, the employee you need, and then retaining that employee. And particularly in some segments, obviously, as you can imagine, construction and agriculture, it is a very difficult time to keep, their labor force at a level at which they need. But if you look at Hispanic employment, the state of Hispanic employment, according to the Department of Labor, between the years 2020 and 2030, a little over 79% of the net new workers entering the American workforce will be of Hispanic descent. So think about that for just a minute. Almost 80% of net new workers between the year 2020 and 2030 will be Hispanics. So this bodes well for a community that continues to grow and continues to want to do nothing more than to contribute to this nation that we love so much. The puts and takes, from a month-to-month basis, it's going to change. There's going to be some puts and takes, and some days are better than others. But the net of it is that Hispanic employment is alive and well in the American economy, and we're thrilled at what we're seeing overall.
Yeah, and Hispanic employment, to your point, is contributing about $800 billion to the American economy when you just look at Hispanic-owned businesses in the United States. I'm curious, when you think about legislation from Washington, what do you think would be, and I see you laughing a little bit there, what do you think would be kind of the single biggest thing that you would hope that legislators in Washington would understand in order to help continue the growth that we're already seeing in these numbers, that $800 billion number that you cite for us?
That's an insightful question. And if I could figure that one out, Madison, but the reality of it is we have a Congress, we have elected officials that appear to be really disjointed from the reality of the marketplace. But with that said, there are some bright spots, some glimmers of hope. I was just with Kirsten Sinema last week. I did an hour-long question and answer session with her. And the reason I was so keen on going to sit with her and talking to her, here is a woman who was the major proponent of the Infrastructure Investment and Jobs Act. She was also a key player in the debt negotiations and saw to it that permitting was embedded into the negotiations. Now, why do we care about those two things? If you look at the infrastructure in this nation, first of all, we rank, I believe, 17th globally, while we're the wealthiest nation on the globe. That's simply unacceptable. But if you look at the industries that fall under that broad umbrella of infrastructure, what are they? Construction, transportation, wholesale, manufacturing. Where are Hispanics employed? Construction, manufacturing. So here's an individual that wasn't looking at it necessarily from a Hispanic perspective, but was clear-minded in terms of what American small business needs. And if you do right by American small business, by default, you're doing right by Hispanic-owned businesses and Hispanic entrepreneurs in this country.
Hey, one thing I wanted to touch on with you, Javier, is child labor in this country and what the Labor Department has recently found. Some kids as young as 13 actually working illegally in really terrible conditions. Talk to me about what you at the U.S. Hispanic Business Council are doing about that and what the reaction from Washington has been. You know, I hear about these stories and I think to myself, this is 2023. How are there kids illegally working in meatpacking plants in the U.S.?
Yeah. Listen, you're talking to a former migrant farm worker, English as a second language kid. I know the conditions that field laborers are working in. I've lived that, and it's deplorable. Things have gotten better since I was there, but it is a very, very difficult environment. I mean, you're working sun up to sundown in the heat, in the rain, in the snow. It doesn't matter. And you're right. The Labor Department found 4,400 cases of children working across a variety of industries throughout the United States. That's a 44% increase from last year. They've levied over $6.5 million in penalties. That's an 87% increase over last year. And while we sympathize with those industries that need the labor, we believe in commerce, of course, but commerce with a conscience. And child labor is it's undeniably wrong. It's undeniably evil. We are America. We can do better than this. We should do better than this. With that in mind, I've been busy all week talking about this, actually. And so I'm glad you asked it, Tim. Bless you for that. But with that, there's another stark reality that we have to deal with at the USHBC, and that is that industries that rely on immigrant labor, i.e. construction and agriculture. I mean, agriculture alone, 73% of the workforce in agriculture is of immigrant background. Yeah. And so there is an environment where over the last decade, technically, our agricultural sector has had a labor shortage. And here's a stark reality. Every year, we lose 10 million tons of produce that goes unharvested. 10 million tons, not 10 million pounds, 10 million tons of produce that goes unharvested. So you can imagine the strain on the agricultural sector. And of course, we represent that sector as well.
So Javier, just because we only have a minute left with you, tell me what is one thing that you wish would be done to specifically address the problem that you're talking about right now when it comes to farming?
You know, there is a piece of legislation called the Dignity Act that, of all things, is being proposed by a Republican Florida woman named Maria Elvira Salazar and a Texas woman Democrat named Veronica Escobar. It is all about making sure that we have the protections that are appropriate and that are right for all people working in America, certainly for children. The Dignity Act, that's something we should really be looking at as a nation.
All right, Javier, thank you so much. This is a great conversation. We're definitely going to have you back because we could have kept it going. Really appreciate you for coming on this Friday afternoon. Javier Palomarez joining us, President and CEO of the U.S. Hispanic Business Council, to talk about those jobs numbers and the work that needs to still be done for this conversation following those jobs numbers from this morning.
This is Bloomberg Businessweek, insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Stocks now lower after spending much of the day higher. That reversal thanks to Apple moving lower, adding to its losses. Apple down right now about 4.6%. But let's talk big picture here, get an idea for what's going on, not just today, but with the macroeconomic picture, and especially after that jobs report, how things are looking for the Fed's September meeting. Very pleased to have with us Leo Kelly, founder and CEO at Verdence Capital Advisors, joining us this afternoon on Zoom from Hunt Valley, Maryland. Leo, good to have you back with us. How are you?
I am well, thanks. It's good to be back. Always enjoy the Bloomberg Radio show.
Oh, well, we love it when you join us. So happy Friday. And thanks again for coming on the program. What are you looking at on a day where we get a jobs report that kind of has a little bit for everyone, but we're still seeing some weakness in the equity market as a result of some of those mega cap tech companies lagging?
Yeah, I think what we're starting to see is that as the market reaches higher and higher levels, it continues to be priced for perfection, and continues that razor thin line of perfection is just getting tighter and tighter. And so the market is going to start to, as it discerns through various different pieces of information, Does this mean the Fed's going to keep raising? Does this mean we're out of the woods, recession, non-recession? I think we're in one of those periods where we're so optimistic right now that the market just wants everything to be good news. And so just slight concerns are really going to have a negative impact on the market.
What's the slight concern of today? Is it Apple's iPhone miss?
Yeah, I think it's Apple's iPhone miss. I also, again, I think we were expecting Apple to just blow the cover off the ball
because it does that every time.
Everything is priced, but that's where the market's priced, whether it's Apple or it's the market as a whole. Remember, this week we've gone down. Earlier in the week, we saw a great ADP jobs number, but just before that, we had the ISM numbers come out. And the forward-looking jobs number for ISM was horrible. It was one of the worst readings since 2020. I think this is indicative of the moment we're in. There's a lot of capital still sloshing around the system. When M2 money supply went up 40% in 2 years, and we just haven't gotten the money out of the system. So you're getting these mixed readings where sometimes the economy looks strong and we're ready to take off. And then the next report, you say, oh my goodness, we might be in a recession by the fourth quarter. So the market, I think, is going to be volatile here. And remember, seasonally, we're heading into a rough spot.
Eddie Ardini said today that we are not in a rolling recession. We're in a rolling recovery. Would you agree with that?
Well, I think we're in an earnings recession, and yet stocks have gone higher. Remember, most of the gains here have been PE expansion, not earnings expansion. I do think when we look, the Fed is going to get what it wants. Inflation is starting to slow down. But if they take their foot off the accelerator even a little bit, inflation is going to come roaring back. And what that tells me is that this hope that the Fed is going to stop and we're going to get a thrust in the economy, I think you have to be very, very cautious with that.
Why are you thinking that the Fed should not lay their foot off the gas here, given that we're still seeing such strong consumer spending, we're still seeing strong wages, strong jobs data?
Well, we're also seeing some weakening. So as I said, ISM, the jobs information was actually not too good, and that's forward looking. We're seeing credit card debt expand dramatically. We're seeing delinquency rates go up. We're seeing the banks starting to take loan loss reserves, and we still haven't seen the impact of what we're seeing consistently in the surveys of tightening credit conditions at banks and commercial real estate. So right now, just to give you an idea, we're neutral in our equity position. We're neutral. And that speaks to where we are. I can point to 10 things that would make you concerned about the economy, and you could point back with 10 that make it look pretty good. And what that speaks to is exactly what we've been talking about on this program for a few years. And that is when you flood the system with trillions of dollars artificially, you create an economic anomaly, the greatest economic anomaly in history. And the result of that is you're going to get these very confusing periods where as we unwind the anomaly, the information's not going to make a lot of sense. We think this is a more cautionary environment. And by the way, you're getting 5% on your short treasury.
Yeah,
so
that's
it's not
true.
like you're not getting anything. It's just now it's not the time to go chase tech, go chase the high price stuff and overweight your portfolio. It doesn't make sense after a run like we've just had.
When does it make sense to deploy new cash into equities? When does it make sense to move that cash that's earning 5% in a money market fund to equities?
Well, you just hit the point square on. Look at the rate of return and the risk-adjusted return. So let's take the S&P. It's 20 times earnings. If we invert that, right, and we take 1/20th, right, that's a quarter. So we're going to make a 10 PE is 10%. Okay, a 20 PE is 5%. And so we're getting 5% on stocks with growth, by the way. So pick an earnings growth number, a few percent with the economy. That's your rate of return. Well, if we're getting 5% on risk-free assets, the question is there enough of a risk premium in those stocks to take that risk? And I would tell you, you have to be very careful. I would also say that there's two different markets at the moment. Remember, 10 stocks are about 30-40% of the return of the market this year. So it's a narrow advance. So you've got this one group of stocks, which, by the way, everybody's chasing, where actually the PEs are astronomically higher, which means the rate of returns are lower versus this cash. So there is a place to put money. Small caps look interesting. Value looks interesting. International developed looks interesting. Emerging markets is starting to come up. You have to just be very discerning of your evaluations.
How do you defend staying on the sidelines, though, to clients? And not even you specifically, but how would you advise that defense? Because we have seen the NASDAQ up, 40% in the first half of this year. How do you not get into this magnificent seven?
Well, I think you just really hit a home a point, right? We're neutral. And yet to clients, that feels like we're on the sidelines.
Yeah.
Right.
And that even the language of saying, hey, just be neutral and it's okay to hold 5% treasuries and be underweight, let's say long-term bonds, which we are, that feels somehow we're on the sidelines. We're not. That's called prudent long-term asset management, right? That's called long-term strategy. I guess the question is, if we were to look back in time, 1999, 2000, 2007, 2008, 1971, going into 72 Nifty 50 crash, right? As we look back in time, everyone would say, hey, I want to sell when the markets are strong and be smart, and I want to buy when markets are down and be smart. And yet, because we're human beings, we continue to do the opposite.
Because we don't know when markets are up or down unless we, have a crystal ball or can, travel in time.
Or you use valuation, you use fundamental valuation, right? It walks you through the process, and you have to have a long-term perspective and not be thinking short-term. It's really simple. And my point of view is this: I'm not suggesting you leave the market or you stand on the sidelines or you try to grab some dramatic moment to put it in. I'm saying with the markets run as far as it has, with the valuations, why be overweight?
Leo Kelly, we love it when you join us, founder and CEO of Verdence Capital Advisors on the Zoom from Hunt Valley, Maryland. Have a great afternoon, Leo. Have a great weekend. We'll talk to you next time. You're listening to Bloomberg Businessweek. This is Bloomberg.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.